My name is Siddiq Farid, founder and CEO of SmartCrowd. Today I'll be discussing two very important things with you guys. One is what's happening with the rental yields in Dubai and whether this is the right time to buy a property in Dubai. So let's dig in. So what's happening to the rental yields in Dubai? Before we dive into it, it's very important to understand what does the yield mean, right? So yield is essentially the rental income that you're getting on the property divided by the property price, which is the gross yield. The net yield would be rental income minus all the costs associated with the property, such as service charges, property management fee, and the net income that's left over, divide that by the property price equals the net yield. What's important to understand is real estate generally presents you with two returns. One is the income return we just talked about, the net yield, and the second is the capital appreciation, the price movement in the property. So what's important is when you're analyzing and evaluating these opportunities, you need to stop looking at them in absolute terms, meaning looking at a property just at 6% yield does not tell you anything. You need to look at 6% relative to what else, what's happening in the market, what is the average of the market, what is the trend of the market, because you need to contextualize whatever you're looking at, because if you look at it in absolute terms, it won't give you any meaning, because you need to understand the context behind it to better understand so you can make better investment decisions. So what's been happening to the rental yield over the last year, 2 years, etc., and what's the expectations going forward? So what's important to understand is, yes, due to recent economic crisis or health crisis, how you want to term it, due to COVID, the rental market has come under pressure, meaning rental prices have come down and have been trending down. So what that has done is obviously has an impact on your income yield, because if your rents are coming down, your costs are not coming down as fast, and the property prices are what they are, which will result in the yields being lower. But what's important to understand is that rentals are usually a laggard indicator compared to the property prices. Because think about it, right? When you rent a property, you usually sign a 12-month lease. So the price might move within that 12 months, but the rent hasn't moved, which will have an indirect impact on what the income yield is being generated on that property. So let's look at an example, right? Let's look at an example of a property that's at 1 million dirhams, and the property is rented for 100,000 dirhams. That's a simple math. That'll give you a 10% gross yield. But let's imagine the rents come down to 80,000, so your yield will drop to 8%. Or let's imagine if 1 year later the price moved up, but the rentals haven't caught up, so your yield will look lower in that instance as well too. So it's very important to understand what's happening with the price movement. You can't just look at the yield in its absolute term independently of what's happening with the price. So, for example, the properties that we were evaluating last year and so forth, we had an indication of the rental market will be coming under pressure because of the supply-demand dynamics that were not in equilibrium. So we knew that there will be a pressure on the rental prices. Obviously, the COVID has accelerated that downward trend and has sort of overshot in terms of the rent reduction in certain places, not in all areas, but in certain areas that has had a negative impact on the yield. But the prices have also have been coming down for a while, and the rent is just playing catch up. So the properties we were looking at last year, we were looking at in the context that we knew the rental prices would be coming down. So what we were looking at properties that had a long lease tenor remaining on them, meaning we preferred properties that had 10 months or longer tenancy contract left, because remember, these properties were rented the year before at higher rent than what the current market was at that time, and we knew the trend was coming down. So the longer we had security of that higher rent, the more revenue we could generate, the more return we could generate for our investors. Hence, and then we knew the trend was coming down, so we were negotiating very aggressively on the entry point, because we knew the rents when they, after 8 months or 10 months when the renewal happened, that the rentals will be lower. So we want to make sure that we went in lower so our yields will be protected, meaning our yields will remain at market or above market trend. And that was a good strategy because the rentals did come down and we are still able to generate above market returns for our investors. So we were able to generate significantly higher returns in the initial months because of our strategy, our focus. But lately, what's happened is that the rental prices have come under pressure quite a bit, and the property prices have already been decreasing for some time. So the downside on the property price is not as much as where the rental downside was, but that has come in already in place. And if you look at since COVID, since April lockdown, and since the reopening of the market here in UAE, things have really picked up. So if you look at the transaction volume in the last quarter, it's been one of the highest achieved over the last few years. In fact, August this year was much higher than August last year in terms of transaction volume, and it's mainly driven by secondary market, which is a really positive sign for the market, because a lot of confidence from investors as well as end users looking to pick up good value of assets, and secondary market is picking up, meaning people are buying ready properties because they see good value in those assets. So what's going to happen is that the prices will start moving much sooner than the rentals will catch up. So it might appear that the rental yields are lower, but in fact that's not the case, because if you wait for the right yield and the rentals to play catch up to be reflected in the price, you will end up paying 5-10% more for the property price than what you'll be paying today. So it's very important to understand that dynamics, because if you don't understand that dynamics, you'll be comparing today's yield of 6.5% to last year's yield of 7% and thinking, hey, this is not a good opportunity for me. It's actually contrary to that, right? Because you're getting an opportunity to buy into an asset that's already come down in price. Rentals have played catch up, but the prices will turn before the rentals turn, right? Because again, if I'm signing a lease contract today for the next 12 months and the rent has come down significantly in the market, that doesn't mean when the prices pick up, the rental will stay. The rental will play catch up, right? But if you wait for the rentals to play catch up and so forth, you would have missed the opportunity to buy the property at the right time. So it's very important that, yes, you should look at the rental return that you're getting, because that's an income that you're generating from your investment. But at the same time, it's very important to look at what's the entry point of my asset. Am I getting a good entry point? And the way you look at that is, again, don't look at the absolute value. Don't say, hey, one bedroom, 600,000, great property. Look at the price per square foot, right? Because you could have one bedroom that's 500 square foot, one bedroom that's 1,000 square foot, etc. So you need to evaluate on a per square foot basis so you can compare apples to apples and look at it from area to area. Don't compare a JVC property to downtown or a marina, because there's different environments, different contexts, different kind of investors, etc. that determine the opportunity. So you got to look at it, and this is where our platform comes in very handy, because we provide you with all this insights to help you make the right decision. So very important to understand that and compare that and make sure you're getting a good capital entry point, because then what that will do is that will preserve your capital. You're buying an asset at a good entry point, right, giving you the best opportunity for capital preservation and capital appreciation when the market turns, and you're getting a good yield in the process, meaning you're getting paid to wait for the market cycle to turn.